In the shadow of glaciers and volcanoes, far removed from Wall Street and the City of London, a tiny island nation dared to believe it could outplay the global financial system. This is not the story of a poor country trying to survive. This is the story of a rich country that flew too close to the sun. Iceland, once a quiet land of fishermen and poets, became the epicenter of one of the most dramatic financial collapses in modern history. In less than a decade, it transformed from one of the world's most stable economies into an unstoppable credit machine. Its banks grew 10 times larger than the entire economy. Its people became overnight millionaires, and its leaders believed the good times would never end. But beneath the surface was a different reality, one built on arrogance, artificial wealth, and unsustainable debt. The warning signs were there, ignored, dismissed, until the crash of 2008 exposed the truth. Iceland's entire financial system wasn't just broken. It was a lie. Banks failed. The currency collapsed. Citizens lost everything. And for the first time in history, an entire nation was declared bankrupt. Not by war, not by natural disaster, but by its own greed. This is not just a tale of numbers and markets. It's a cautionary saga of human ego, unchecked ambition, and a nation seduced by the illusion of wealth. Because when greed spreads faster than common sense, even a peaceful island can become the ground zero of global economic disaster. This is the story of how Iceland rose like a phoenix, then burned like a firestorm. The greed that bankrupted a nation. At the edge of the North Atlantic, a small island nation once known for its rugged fishermen and ancient sagas quietly transformed into one of the world's most ambitious financial experiments. Iceland, population barely over 300,000, wasn't supposed to play in the big leagues of global finance. But in the early 2000s, a radical shift began to stir beneath its icy surface. What started as a simple economic reform spiraled into a bold, dangerous dream. Iceland decided it no longer wanted to be the humble outpost surviving on cod and tourism. It wanted to be a player. And so, the fishing nets were traded for neckties, and Reykjavik skyline began to rise with glass towers, bank headquarters, and the unmistakable scent of fast money. It all began with privatization. In the late 1990s, Iceland's government, like many others influenced by neoliberal ideology, began selling off its major banks. The process was rushed, the regulations were loose, and the oversight was virtually non-existent. 3 banks, Glitnir, Kaupthing, and Landsbanki, emerged from the ashes of public ownership and quickly morphed into monsters fueled by cheap credit and unchecked ambition. They didn't just want to dominate Iceland. They wanted to take over Europe. With the Icelandic krona pegged loosely and the European credit markets wide open, these banks began borrowing vast sums in foreign currencies. Billions flowed into their coffers. But they didn't stop there. Using those borrowed funds, they started acquiring foreign companies, buying real estate, investing in media, and lending recklessly. They even loaned money to their own executives to buy shares in their own banks, creating a financial echo chamber of artificial value. At first, it worked like magic. Iceland's economy boomed. Wages soared. Icelanders were suddenly wealthier than ever before. Luxury cars lined the streets of Reykjavik. Young bankers in their 20s and 30s flew first class, sipped champagne in London, and partied in Dubai. Iceland's people believed they were witnessing a miracle. The media called it the Nordic tiger. But behind the glitter, the numbers didn't add up. Iceland's banks had grown so large that their combined assets were 10 times the size of the country's GDP. It was as if a small-town convenience store had turned itself into Walmart overnight, without the infrastructure, experience, or safeguards to support it. Still, few dared question it. The government celebrated the prosperity. Regulators were either too trusting or too complicit. And the people, caught in the euphoria of fast wealth, didn't see the storm brewing. The transformation was complete. Iceland, once a symbol of simplicity and resilience, was now a house of cards built on loans, leverage, and limitless greed. But every miracle has a price. And Iceland was about to learn just how brutal that price could be. Because when the world catches a cold, small countries like Iceland don't just sneeze, they collapse. At the center of Iceland's financial explosion stood three towering names: Glitnir, Landsbanki, and Kaupthing. Together, they weren't just banks. They were empires. And in just a few short years, they would rewrite Iceland's fate, turning it from one of the world's most stable societies into the poster child of financial collapse. Each bank played a different game, but all chased the same illusion: exponential growth in a world that rewards boldness, not caution. Glitnir, the first to rebrand from its old government name, was obsessed with image. It threw lavish events, sponsored sports teams, and plastered its name across Europe. It moved fast, too fast. From Reykjavik to London to Shanghai, Glitnir opened offices with a swagger that masked its fragile foundation. It lent money freely, often to Icelandic investors who had no realistic chance of paying it back. But it looked good on paper, and that was enough for a while. Landsbanki took a different route. It found a shortcut into the wallets of foreign savers. With a product called IceSave, it offered sky-high interest rates to average Europeans, mostly British and Dutch citizens. The promise was simple: deposit your money online, and we'll give you returns far better than your local bank. The strategy worked like a charm. Billions poured in. But there was a catch. These weren't traditional savings accounts. The deposits weren't backed by a real safety net. And if anything went wrong, the consequences wouldn't just hit Iceland, they would ripple across entire countries. Then there was Kaupthing, the biggest and boldest of the three. Kaupthing wanted to play with the big boys. Its executives styled themselves as visionaries. They talked like Wall Street, acted like investment kings, and spent like royalty. Kaupthing bought banks in Europe, financed billion-dollar deals, and poured cash into Iceland's elite. They gave out loans to insiders, celebrities, even politicians. No due diligence, no questions asked. Many of the borrowers never even had to pay the money back. It was one giant web of back-scratching and self-enrichment. From the outside, Iceland looked like it had discovered a new economic model, one that defied gravity. But behind the boardroom doors, everything was built on debt. The banks were borrowing in foreign currencies, euros, dollars, pounds, but their customers were earning and repaying in Icelandic krona. If the krona fell, the entire system would snap. And yet, nobody seemed to care. The government, basking in the glow of national prosperity, ignored the warnings. The central bank, small and under-resourced, was powerless to stop the runaway train. And the Financial Supervisory Authority, Iceland's regulator, was asleep at the wheel. Or worse, riding shotgun. What made it even more dangerous was how interconnected it all became. The banks weren't just lending to outsiders. They were lending to each other. Glitnir would loan money to investors who used it to buy shares in Kaupthing. Kaupthing would turn around and invest in funds tied to Landsbanki. It was a circular economy of fantasy financing, an economic Ponzi scheme disguised as innovation. By 2007, the three banks had ballooned to nearly $180 billion in assets, 10 times Iceland's GDP. That would be like a single U.S. bank holding $250 trillion in assets. The math was insane, but in the frenzy of global credit, nobody stopped to check the calculator. Iceland had become a financial time bomb, and the fuse had already been lit. The question was no longer if it would explode, but when. Iceland wasn't just playing the finance game. It was rewriting the rules. With the big three banks expanding like wildfire, the nation found itself living in a state of collective delusion. Everyone, from top executives to everyday citizens, believed the prosperity was real. But beneath the surface, everything was smoke and mirrors. The illusion was built on leverage. The banks were borrowing staggering amounts of money from abroad, often in foreign currencies, and using it to buy everything they could get their hands on: foreign companies, prime London real estate, even private jets. Icelandic businessmen were suddenly billionaires on paper, and the media hailed them as visionary capitalists. But the reality was darker. These banks weren't growing through profits. They were growing through loans, most of them toxic. In some cases, they weren't even lending to real businesses. They were lending to friends, cronies, and shell companies, often with no expectation of being repaid. Worse, many of the biggest loans were used to buy shares in the very banks issuing them, creating a financial feedback loop that artificially inflated their stock prices. On paper, everything looked healthy. In truth, it was a house of cards propped up by creative accounting and sheer audacity. The average Icelander didn't see the danger. Their homes doubled in value. Their salaries climbed. Foreign goods flooded the shelves, and international travel became routine. Everyone was winning, or so they thought. Meanwhile, the banks kept inflating their balance sheets. They boasted about acquisitions, strategic expansions, and risk models that supposedly made them untouchable. But their actual liquidity, the cash needed to survive short-term shocks, was vanishingly small. They were running a global financial empire on borrowed time and borrowed money. Still, no one wanted to question the miracle. Not the regulators, not the politicians, not the citizens, because to challenge the illusion meant risking the dream, and the dream was too intoxicating to give up. But all illusions have a breaking point, and Iceland's was drawing dangerously close. By 2007, the first tremors started to shake Iceland's financial foundations. International markets, once eager to lend, grew wary of the island's meteoric rise. Analysts began asking questions. How could three banks from such a small country manage tens of billions in foreign assets? Why were so many of their loans going to insiders? And why was Iceland's central bank unable to backstop its own banking system? Investors started to pull away. Credit lines tightened. And beneath the glossy facade, liquidity dried up fast. The cracks were subtle at first. Glitnir began having trouble refinancing its short-term debts. Landsbanki faced scrutiny over its IceSave accounts, which had raked in billions from European savers with no clear protection in place. And Kaupthing, the boldest of them all, suddenly found its access to foreign funding disappearing. Still, Iceland's leaders downplayed the danger. The prime minister insisted the economy was sound. Bank CEOs gave interviews claiming they were victims of foreign jealousy. They blamed the media, hedge funds, even credit rating agencies. But none of it stopped the bleeding. Behind closed doors, the panic had already begun. The banks turned to the Central Bank of Iceland for help. But it was a Band-Aid on a bullet wound. The central bank's reserves were tiny compared to the size of the banking sector. It could barely support one of the big three, let alone all three. By late 2008, global financial markets were in turmoil. The collapse of Lehman Brothers in the U.S. sent shockwaves across the world. For Iceland, it was a death sentence. The country's foreign lenders demanded their money back, but the banks couldn't pay. The currency collapsed, and the value of foreign debt exploded overnight. On the streets of Reykjavik, confusion turned to fear. People rushed to withdraw their savings. Businesses froze. Supermarket shelves began to empty. And still, the government insisted everything was under control. It wasn't. The illusion was cracking. The walls were closing in, and Iceland was just days away from total collapse. It didn't take a war. It didn't take a natural disaster. All it took was 1 week in October. Iceland's banking system, once hailed as one of the most innovative in the world, collapsed like a house built on wet sand. And when it fell, it didn't just take down the banks. It took the entire country with it. It began with Glitnir. In a desperate attempt to stave off insolvency, the government moved to nationalize the bank. But the move came too late. Confidence evaporated overnight. The krona dropped like a stone. International credit ratings were slashed. And the financial world realized something Iceland had been hiding. It couldn't save its banks. They were simply too big. Next was Landsbanki, the pride of Iceland's foreign reach. The IceSave accounts, once praised as a modern banking miracle, became a ticking time bomb. The British government, fearing for its citizens' deposits, invoked anti-terror legislation to freeze Landsbanki's assets. Iceland had officially become a financial pariah. The word terrorist was now attached to a peaceful Nordic island because of a bank run. Then came the giant, Kaupthing, the crown jewel of Icelandic ambition. Within days of Landsbanki's fall, Kaupthing was finished. It defaulted on its debts, lost foreign support, and imploded under the weight of years of reckless expansion. All three banks gone. Just like that. ATMs ran out of cash. Supermarkets couldn't restock shelves. Imports halted. The krona became worthless abroad. Icelanders watched as their pensions vanished, their life savings evaporated, and their economy disintegrated. Businesses folded. Unemployment surged. Young professionals who once flew first class to London were now jobless, grounded, and ashamed. A nation that had tasted wealth like never before now stared into the abyss of bankruptcy. But the most devastating part? The silence. No one was held accountable. Yet, the bankers vanished. The politicians ducked. And the people were left alone, in the cold, wondering how they were sold a dream that turned into a nightmare. The collapse was complete. Iceland was no longer just in crisis. It was broken. But out of that wreckage, something unexpected began to rise. They called it the Pots and Pans Revolution, a name that sounded innocent. But the rage behind it was volcanic. In the months that followed the collapse, Iceland's people did something few expected. They didn't stay silent. They didn't wait for foreign help. They didn't accept the betrayal. They marched. Every week, thousands of citizens, ordinary Icelanders, not radicals, gathered in Reykjavik's snowy streets, banging pots and pans outside Parliament. The message was simple. Someone had to pay. This wasn't just a financial collapse. It was a betrayal of trust, a national humiliation. Icelanders had been told their banks were world-class, their economy the envy of Europe. Now, they stood in lines for bread while politicians gave vague promises on television. The protests grew louder, louder than any in Icelandic history. Eventually, the pressure broke the government. In January 2009, Prime Minister Gerhard resigned, becoming the first world leader to fall as a direct result of the global financial crisis. A new government came into power, and with it, a bold new idea: let the banks fail. No bailouts, no golden parachutes. Let the executives face trial. Let the people rebuild, not the crooks who tore the country apart. This was unheard of. In the US and Europe, banks were being rescued with taxpayer money. In Iceland, they were being dismantled. The government imposed capital controls. It launched criminal investigations. And for the first time in modern financial history, bankers were going to jail. The world watched, stunned. How could this tiny, frozen nation do what global superpowers wouldn't? Because Iceland didn't have a choice. It was too small to absorb the damage, too proud to let slide, and too angry to forget. The pots and pans were put away, but the sound of that revolt echoed far beyond Iceland's shores. In most countries, the powerful never fall. In Iceland, they did. As the dust of collapse settled and the streets quieted, the nation turned its focus to accountability. It wasn't enough to protest. Iceland wanted justice. Real justice. Not just headlines, not just apologies. The people demanded names, faces, charges, and they got them. In an unprecedented move, Iceland launched a special investigation commission to uncover the truth. This wasn't some bureaucratic whitewash. It was a forensic deep dive into the dark heart of the collapse, examining email trails, loan books, secret memos, and shadowy connections. What they found was staggering. Top bankers had knowingly approved high-risk loans with no collateral. They had manipulated share prices by lending money to clients to buy shares in their own banks. They faked liquidity, misled investors, and enriched themselves with insider deals. These weren't mistakes. These were crimes. The investigation named names: CEOs, CFOs, board members, even central bank officials. Some fled. Others stayed and fought. But the tide had turned. Iceland wasn't just exposing them. It was preparing to prosecute. In 2012, the first convictions came down. Rýr Sigurðsson, the former CEO of Kaupthing, was sentenced to prison. Sigurðsson Arnason, Landsbanki CEO, too. Executives who once signed billion-dollar deals now wore prison uniforms. To the world, it was shocking. Bankers didn't go to jail in New York. They didn't go to jail in London. But in Reykjavik, they did. Iceland had drawn a line in the snow. Corruption wasn't something to regret. It was something to punish. And while the prison sentences weren't long by global standards, the symbolism was seismic. A country had dared to challenge the myth of untouchable financial elites and won. But justice alone wouldn't rebuild an economy. Now came the harder part, learning to live without illusion. With the banks dismantled and the guilty punished, Iceland stood at a crossroads. It could have become a permanent cautionary tale, a frozen relic of economic disaster. But instead, it chose something rarer, a second chance. It began with capital controls. To stop further collapse, Iceland froze the outflow of money. Investors couldn't pull their cash. Citizens couldn't move funds abroad. It was drastic, but it worked. The bleeding slowed. The panic paused. Next, Iceland let its currency, the krona, devalue. It was painful. Imports became expensive. Inflation surged, but it made Iceland competitive again. Suddenly, foreign tourists found Iceland cheap. Exports recovered. The local fishing industry, long neglected, surged back to life. The government then restructured debt, not by protecting the banks, but by protecting the people. Many citizens had taken loans in foreign currencies. When the krona crashed, their debts tripled overnight. Iceland declared those contracts illegal. It was a bold move, one that would have sparked lawsuits in other countries. But in Iceland, it brought relief. The nation also reinvested in what it knew best: clean energy, fishing, tourism, and tech. It didn't try to rebuild its banking empire. It left that dream behind where it belonged, in the wreckage. By 2015, Iceland had done the unthinkable. It had paid back its IMF loan ahead of schedule. Unemployment had dropped. Growth returned. The nation that once made headlines for collapse was now making headlines for recovery. But make no mistake, this wasn't a happy ending. Many families never recovered their savings. Many young people left the country, chasing jobs abroad. And for a generation, the name Glitnir would mean betrayal, not brilliance. Still, Iceland had done something rare in modern history. It faced the abyss and chose to climb out of it, not by doubling down on the system that failed, but by walking away from it. The scars remained, but so did the lessons. Iceland had burned. Iceland had rebuilt, but the world barely flinched. Despite all the headlines, the courtroom trials, the street protests, and the extraordinary national reckoning, the global financial system kept turning as if nothing had happened. To the big economies, Iceland was a footnote, an anomaly, something that could never happen in London, New York, or Frankfurt. They told themselves Iceland was too small to matter. They called it unique, remote, non-replicable. But they were wrong. The greed, the recklessness, the blind faith in never-ending growth, those weren't Icelandic problems. They were global features. The same leverage games, the same oversized banks, the same cozy ties between politicians and financiers. Iceland just happened to be the first domino to fall. And while Iceland's people took to the streets and demanded justice, most other countries did the opposite. They bailed out their banks. They protected their executives. They rewarded failure with golden parachutes. In the United States, not a single senior banking executive served jail time for the 2008 crisis. In Europe, austerity was imposed on the poor while bankers remained untouched. Iceland's defiance was an outlier, not a blueprint. Even more alarming, within just a few years, the same risky behavior began to creep back into the global financial system. Exotic derivatives returned. Shadow banking thrived. Big banks became even bigger. And no one seemed to remember what nearly brought Iceland to its knees. Iceland had screamed a warning to the world. The world shrugged. But the lessons were still there, written in the frozen soil, the court records, the broken lives, and the rebuilt streets of Reykjavik. Lessons about limits, about greed, about what happens when fantasy outpaces reality. The question wasn't whether Iceland had learned. It was whether anyone else had the courage to follow. 15 years after the fall, the scars of Iceland's financial collapse remain, not just in the economy, but in its soul. For those who lived through it, the trauma runs deep. The fear of opening bank statements, the shame of defaulting on mortgages, the disbelief of watching an entire system vanish overnight. These weren't numbers on a chart. They were lives uprooted, dreams lost, futures rewritten. But Iceland is not a country of victims. It's a country of survivors. Today, its capital is thriving. Tourists flock to its waterfalls and volcanoes. The tech scene is growing. Its renewable energy powers homes and industries alike. On the surface, Iceland looks reborn. But behind the beauty lies a deeper legacy, one of vigilance. Icelanders now question more. They demand transparency. They remain skeptical of unchecked wealth and political spin. Their story is told in schools. Their mistakes are studied in universities. Their revolution, though quiet, has become part of their national identity. And while the rest of the world moved on, Iceland never forgot. Because it couldn't. The collapse was more than a financial disaster. It was a mirror, a reminder of how fast things can fall apart when people trade prudence for profit and truth for illusion. This is the legacy of Iceland's collapse. Not just a story of what went wrong, but a rare example of what happens when a nation refuses to stay down, when it chooses honesty over denial, accountability over comfort, and justice over silence. The world may have ignored the warning, but Iceland lived it, and for that, it will never be the same. This was the greed that bankrupted a nation. This was the true cost of believing the dream was real. What happened in Iceland wasn't just a collapse. It was a warning, a crack in the illusion of endless profit, and a brutal reminder that when the rich gamble with lives, the people always pay the price. They called it a miracle economy, until it exploded like a bomb made of money, lies, and unchecked power. But the question is, could it happen again? Not in some distant land, but right under your nose. Because the greed that bankrupted a nation never really went away. It just changed its name, changed its suit, and moved on to its next victim. If this story shook you, made you think, or open your eyes, don't let it end here. Like this video, so the algorithm knows people still care about the truth. Comment below, what shocked you the most about Iceland's fall? Share this video with someone who still thinks it could never happen here. Subscribe to Money Traps for more shocking, true financial stories they don't want you to hear. And don't just hit the bell. Smash it, so you never miss what's coming next. Because in a world ruled by money, the next trap is always being set. Stay sharp. Stay awake. This is Money Traps,